Is EBITDA a scam? Is it really important? The answer is, well, it's a bit more complicated than that. When you sell your business, the difference between just $10 million and $30 million can be a bit cloudy. So before selling, you need to know what you're looking for. EBITDA is there to make things clear, to add clarity. Do you know what earnings are for a company? The net income. It's the sales minus the cost of goods sold minus the operating expenses equals the earnings. But what is EBITDA? EBITDA is an acronym that stands for earnings before, one, interest. This is the cost of capital. You borrow money, there's an interest rate on the loan, you pay that interest every quarter, month, whatever the agreement is. But the expense of the interest is included in the operating expenses of the company, and therefore it takes away from the earnings. And thus, when we are calculating EBITDA, we add that figure back. And so the reason we add interest back is because not everybody is going to capitalize a business the same way. Now, what we mean by that is not everybody's going to take the same amount of debt. Not everyone's going to have the same amount of equity. If you buy a house, some people like to own their house in cash. Some people like to put down 5% and borrow the rest to buy swimming pools, billiards tables, boats, and other very intelligent financial decisions. But nonetheless, the point of it is that you add interest back to show what the normalized level of cash flow is from the business, irrespective of how much debt someone may have on the company. Two, taxes. We like to say Uncle Sam is a relative, but a distant one. However, every company needs to pay taxes. As you succeed in business, initially you get to pay the IRS, or whatever the tax authority is in your country, buy them a car. Soon enough, you get to buy them a house every year. Yippee. However, when we're calculating EBITDA, we are adding back the taxes because dependent on what type of company you have, the structure of it, an S Corp, an LLC, a C Corp, it has different tax implications. And so we add that figure back into the EBITDA calculation. So again, taxes are very unique for every situation. C Corps pay a corporate tax. LLCs and S Corps will pay self-employment taxes on the LLC side of things. S Corps will pay effectively dividend taxes. If you own a Greek diner, you probably don't pay any taxes because you can stuff it all into the second cash register. And I can make that joke from my own heritage, and my great-grandparents, God rest their soul, would be very happy in how much money they buried in their mattresses. Jokes aside, we add taxes back because, again, depending on the situation of a particular company, they're going to have a very different tax situation. Adding taxes back helps normalize EBITDA, helps us look a little bit closer as to kind of what the numbers would look like, again, agnostic, without a deference to a particular type of tax structure. Number three is depreciation. Depreciation is a non-cash expense on the balance sheet in attempt to take into consideration fixed assets deteriorating over time. That sounds really complicated, but the simpler way to say it is if you have machines in a company, at some point they're not going to work. Now, whether it's a donut making machine or your old Pentium 1 IBM computer, there's a shelf life to these types of machinery, whether, again, it could be heavy machinery, light machinery, whatever it is. But the thought behind depreciation initially was to allow a company to expense a portion of the cost of an item over its lifetime such that you're effectively saving the tax money to buy stuff again when it needs to be replaced. The reason why that's added back is because it's a non-cash item. So as the tax code has gotten more complicated and hard to understand than a Kanye West interview, the depreciation has not always kind of truly tracked the actual deterioration of the equipment. So at this point in time, it's effectively a tax savings attributed to certain items. And again, it could be heavy machinery or a G-Wagon. I mean, there's a lot of things that kind of fit different elements within the tax code. But that being said, we add depreciation back because it's a non-cash expense, which again helps normalize the EBITDA figure. And number four is amortization. And so to add even another element of complication, amortization is effectively the deterioration of intangible assets. And so largely where you see this is if you were to acquire a company, you get certain goodwill from that company onto your balance sheet that you're allowed to write off over a period of time. Now, the goodwill that's on the balance sheet or other amortizable items It's not really deteriorating over time. It's again kind of more of a tax structure that allows for certain savings, but it's not really indicative of the profitability of the company. And so we add the amortization back just like we do the depreciation. Okay, so now you know a bunch of acronyms, what letters stand for, and why one should add them back, or the logic behind why they are added back. But to get to the question, is it a scam? Does it matter? Why is it important? Why do people keep saying this word when they talk about the value of a business? So the point of EBITDA is to be the most accurate portrayal of the true cash flow generating power of a business. We add back the things that are specific to ownership, that being the interest, that being the taxes, and we add back non-cash expenses, the depreciation, the amortization. So truly what EBITDA is trying to represent is effectively what is the cash flow of a business. The sales minus the cost of goods sold minus the operating expenses equals EBITDA. Again, the operating expenses being normalized to get rid of these owner-centric issues as well as non-cash items. Now there are other items that we've addressed in other videos of ours, and we'll point somewhere in the screen and throw a thumbnail in there as to how EBITDA is even further enhanced to show the most accurate portrayal of cash flow generating power of a business. However, the point of it is, and why it is not a scam, is it's trying to get to the essence of a business. When you look at how fast a car can drive, you don't want to say how fast can a car drive if the driver's eating McDonald's and there's 3 people sitting on the hood and it's going through a swimming pool full of Jell-O, right? Stupid examples aside. You want to know, okay, it's a dry road, it's on simple pavement, the car's going, how fast does it go? And so it's the same thing with business. Let's try to normalize the conditions. I don't really need it to be hailing in Utah to drive a Bugatti down a salt pond, right? Let's just say, how can the business perform in the most normalized, clear, understandable fashion? And that's what EBITDA is to show. And that's why, as much as some people may say it's not the most important metric, and that is true. There are other variables that help contribute to the value of a business. However, it is incredibly important. It is oftentimes kind of the first dart against the wall upon which value can either enhance or detract, but it's usually the starting point for value in all valuation discussions for all deals across the entire middle market, lower middle market of business exits. And so, if you want to understand what EBITDA is, if you want to understand what your EBITDA is, how it impacts the value of your company, make sure to sign up for our newsletter, subscribe to our YouTube channel, follow us on LinkedIn. Again, for in-depth videos like this every week, as well as for daily content relative to how to sell businesses, how to find capital, and how to make sure you optimize the value of your business. Appreciate everyone taking the time. Keep pushing forward. God bless. We'll see everyone next time.